You wake up one morning and decide to buy a house. You've got a job, you've got savings, you've got ambition. The bank runs your numbers. They don't ask if you're responsible. They don't ask if you're kind. They don't ask if you pay your friends back. They look at one thing, a number, 720. The banker smiles, 780, you're golden, 580. The smile disappears. Same person, different number, different life. So what is this number? And why does it feel like an invisible ladder you're climbing or sliding down without ever seeing the rungs? Let's make it simple. Imagine your financial life is a ladder, not a metaphorical climb to success ladder, a literal one. At the bottom, no credit or bad credit. At the top, perfect credit. The higher you climb, the cheaper money becomes. The lower you fall, the more expensive life gets. That's it. That's the whole system. But how did we end up here? Rewind. Not to ancient gold, not to kings, to the 1950s. Banks used to decide loans the old way. You'd walk in, sit across from a man in a suit. He'd look at you, maybe ask about your family, maybe ask who you knew. You seemed trustworthy, loan approved. You did, too bad, it was subjective, messy, biased. Banks wanted something cleaner, so they built a formula, a machine that reduces your entire financial behavior into a score, your ladder. Today, that ladder usually runs from 300 to 850. But here's the part nobody tells you. The ladder doesn't measure wealth. It measures obedience. Every rung represents one thing. Did you pay back money exactly how and when you promised? Not early, not late. Exactly, miss a payment, you slip, max out a card. You wobble, close an account, the ladder shifts. Open too many accounts, the ladder creaks. You're not climbing with strength. You're climbing with behavior. Let's break the ladder into rungs. First rung, payment history. This is the big one. Miss a payment by 30 days, the ladder jerks downward. Miss it by 90, you lose your grip, because to the system, a late payment isn't a mistake, it's a signal. Second rung, utilization. That's how much of your available credit you're using. Imagine your ladder has weight limits. You have $10,000 available. Use $2,000. You're steady. Use $9,500. The ladder starts shaking. The system doesn't care if you plan to pay it off tomorrow. It sees risk. Third rung, length of credit history. The older your accounts, the more stable your ladder. Close your oldest credit card. You just sawed off a rung you were standing on. Fourth rung, credit mix. Credit cards, car loans, mortgages. The system likes variety. It's not enough to climb. You have to climb correctly. Fifth rung, new credit inquiries. Apply for too many loans at once. The ladder assumes you're desperate, and desperate climbers fall. Now here, where it gets interesting. The ladder isn't moral. It doesn't know if you lost your job. It doesn't know if you had medical bills. It doesn't know if inflation doubled your rent. It only knows pattern. And once you understand that, you realize something uncomfortable. The ladder doesn't reward being debt-free. It rewards managing debt well. You can have zero debt and a mediocre score. You can owe hundreds of thousands and sit at the top, because the ladder doesn't measure freedom. It measures compliance. Now let's talk about gravity. When you're at the top of the ladder, money becomes cheap. Banks compete for you. Low interest rates, premium cards, bigger limits. Your climb gets easier. When you're near the bottom, money becomes expensive. Higher rates, security deposits, loan denials. You don't just fall. The system adds weight to your ankles. This is why two people with identical incomes can live completely different financial lives. One pays 3% on a mortgage. The other pays 8%. One gets approved instantly. The other gets rejected automatically. Same effort, different rung. And here's the trap. When you're low on the ladder, life gets more expensive. When life gets more expensive, it becomes harder to climb. Miss a payment because your rate is high. You fall further. Now your rate goes even higher. This is how the ladder turns into a loop. But it's not designed to punish you personally. It's designed to price risk. Banks don't hate you. They fear uncertainty. The credit score is just a shortcut, a signal, a probability calculator. It asks one question: how likely is this person to cost us money? And then it answers with a number. That's all. No conspiracy, no morality, just math. But math changes lives. Because once you're high enough on the ladder, you stop thinking about approval. You think about leverage. And once you're low enough, you think about survival. That's why credit feels emotional, because the ladder controls access. Housing, cars, business loans, sometimes even jobs. And you rarely see it directly. You only feel the outcome: approval, rejection, higher rate, lower rate. Now here's the final twist. The ladder never ends. There's no done. You don't reach 800 and retire the system. You maintain it. Forever, close one account wrong, slip. Miss one payment during a bad month, slide. The ladder doesn't care about your streak. It only cares about consistency. So what is a credit score really? It's not wealth. It's not character. It's not intelligence. It's a behavioral rating inside a lending system, a ladder that measures how predictably you handle borrowed money. Climb high enough and money becomes lighter. Fall low enough and it becomes heavy. Same world, different rung. And once you see the ladder, you stop taking the number personally. You start seeing the system for what it is. Not good, not evil, just a ladder. And every month you're either climbing or slipping quietly.